Good afternoon, everyone. I'm Millie Hong, Head of Events at ASIFMA. Thank you for joining us today at this virtual event, India Financial Markets, Navigating COVID-19. Let me introduce our host today, Mr. Mark Austin, CEO of ASIFMA. Mark, over to you, please.
Thank you very much, Millie. Really happy to be here today, and we're very, very excited to bring you this Indian financial markets navigating COVID-19. And we've got a very, very exciting lineup for you. But before I introduce that, let me thank Edelweiss as our lead sponsor. And you'll see that there's a number of Edelweiss individuals speaking today. So thank you very much. Without you, this wouldn't be possible. I also wanted to thank very quickly the endorsers, ANMI, Kofia Trade Association in Korea, and PASLA. And thank you very much for endorsing this event. I'm going to quickly go on to just an overview of the sessions. We have a keynote here today, and then we have three panels that we're following this with. An FPI access panel, which is moderated by Laurence, an equities panel, which is moderated by Lyndon, and then a fixed income panel, which is moderated by Rebecca. But without any further ado, because we have time is limited, I wanted to turn over to our keynote, and that is Kapil Gupta, who's Chief Economist for Edelweiss, and he's going to talk about the Indian economy, both retrospectively from COVID-19 and prospectively after we're getting out of it in India and elsewhere. So I'll turn over very quickly to Kapil, and thank you very much for speaking here today.
Thanks, Mark. Hello, everybody. Over the next 10 minutes or so, I'll try to lay down my thought process essentially in three. In the first one, I'll try to lay out what Indian economy was before COVID-19 situation. The second part, I'll touch on what is the situation under COVID-19.
Kapil, your sound is a bit off at the moment. You're echoing quite a bit.
Okay. So I'm not sure what is better.
Yeah, it's still happening, unfortunately. I mean, when we tested it earlier, it worked fine, but I'm not sure exactly why you're echoing at the moment.
So should I?
I wonder if maybe you can switch your microphone on and off and see if it works.
Is it better? No.
No, it's not, unfortunately. I don't know, Millie, if you've got a suggestion because we can see you perfectly clear. It's just the sound quality that's very poor.
Sorry, is everybody else on mute? Maybe someone's speaker is echoing. Or Kapil, you can try with headphones and speaking in. Try that.
So let me get my headphones. Yes.
Guys, sorry, people, just bear with us a minute, and I think Kapil will try to get some headphones on and speak through that. And Shiv, everybody else is on mute other than myself. And
Now.
sorry, Kapil, it's still very, very poor. I don't know. Do you have a microphone, or is it just onto your laptop or your?
Yeah, just on my laptop actually. Yeah. Mine. Should I try log again?
Maybe the only thing I can think of is try to log out and log back in and see if that fixes it, because it's quite bad. I mean, your video is fine, but it's just the echo of the voice.
Let me try to and just log out.
Apologize to everybody who's dialed in. I know we have 165 participants, so we'll just give Kapil a minute or two to see if this works, and then hopefully we can have him speaking to you in a minute, because I know that obviously I think that all of you will very much want to hear him set the overview of what has been going on pre-COVID-19 in relation to the Indian economy, and then how India has been managing through COVID-19 and how he anticipates it will be coming out of COVID-19. So I just want to give him a minute or two to see if he can clear up the technical issues in relation to his voice before proceeding. Thank you again for your patience. It's very much appreciated. Unfortunately, when you're trying to do these things across many time zones and many different countries, you can sometimes have these problems, even if we tested with everybody before we got on a moment ago when it worked fine. I see we're still adding participants. So if you're just joining and you're wondering why the event has not gone ahead, it's because we're having some technical problems with Kapil Gupta, the chief economist and our lead speaker. So he's back now. Let's see if it works this.
Am I
It works
audible?
perfectly well now.
Okay,
Thank you very much. And sorry,
you.
we'll give you the full 10 minutes, Kapil.
Yeah,
and,
my apologies.
we really, no, it's not your fault. I mean, this just happens, and I know people are very excited to hear about what you have to say, both retrospectively and prospectively. So, without any further ado, I'll hand over to you, Kapil.
Okay, sure. So, as I said, 3 parts: pre-COVID, COVID, and where we go from here. In the pre-COVID situation, I think it's fairly known that Indian economy was in a slow lane. If you look at the hard frequency indicators, more bona fide ones like tax collections or industrial production or wage growth, they were relatively in slow lane for some time. And I think I'll attribute 3 reasons. One, I think 2014-15 onwards, India's policy making decisively shifted from growth-oriented policies to inflation containment policies. And that was much needed at that time because inflation was running at double digits for 6-7 years. And RBI and the government both took a firm stance against inflation, which was quite successful in bringing down inflation. But as it always happens, the flip side of that was that in the near term, aggregate demand started to slow down. The second reason was that while the economy was in a slow mode, government, to its credit, actually subjected the economy to significant reforms, and they got bunched up also between 2015 and 2018, one after the other. Many of them were very well intentioned and much desired. Some of them were not so good. For example, demonetization was one reform which kind of slowed the demand pace even more. But outside that, GST or bankruptcy code reform, monetary framework reform, and power sector reform, ease of doing business, I think India has been making significant progress. But again, the flip side of that, as it often happens, is that in the near term, reforms are a little bit demand reducing while they lift the growth potential from the medium term perspective. And really the third thing, which also worked against the demand situation in the economy, was really the global trade. Remember, global trade peaked out in 2014-15, and since then it has been a struggle globally for one reason or the other. And India, while not a very big exporter, unlike some of the Asian countries, it does matter a lot, both for the current account deficit positioning, but also very, very importantly that about 35 to 40% of India's exports are actually labor-intensive exports. So it has a multiplier on the job generation and so on and so forth. So I think these 3 factors put together kind of slowed down the economy, even as it was raising the potential growth rate, both from the reforms perspective and generally a relatively contained level of inflation, which is always good for savings and medium-term investment point of view. Now, with this backdrop, as we were beginning this year, early 2020, I think the economy started to stabilize. the near-term impact of reforms was beginning to subside. Inflation was very contained. Liquidity conditions improved dramatically. RBI was turning from inflation fighting to growth supportive already, which was working to show, which started showing short-end rates. And export cycle was also bottoming out. And we also saw that NPAs or non-performing assets also peaking out. So I think some sort of bottom formation in the economy was beginning to happen as we started this year. Unfortunately, we had this health crisis which struck and kind of derailed that process. So if you look at the second part, which is the COVID situation, really. So economy was put into a lockdown very early stage, and lockdowns were quite stringent. If you compare relative lockdowns, as many of these think tanks do, then India is roughly among the top bracket in terms of stringency of the lockdowns. And this is very much consistent with the economic data, which we have seen in the early part, where we saw trade indicators like imports and exports or car sales, industrial production, PMIs. All these indicators, actually, if you compare relative to other emerging markets or developed economies, India faced a bigger or sharper fall, straight away coming from the fact that our lockdowns were quite stringent initially, right? But what we are seeing right now, as economy has begun to open, and it's a step-by-step process rather than a one-step process. So what we are seeing is that some of the indicators, high-frequency ones, have started to show some traction, but not all. You need to divide these indicators into production side indicators and demand side indicators. And what we are seeing and noticing right now is that production side indicators have started to pick up a little more rapidly compared to the demand side indicators. So for example, some of the high frequency data which is available, let's just say on e-way bills, which is tracks the movement of goods in the economy. There we have seen some significant improvement. In April, it was minus 80% down. In May, we see it's minus 50%. So it's an improvement, although right now it's still weak. If you look at diesel consumption, that also kind of fell to a low of minus 60% in April, and it has recovered to minus 30%. Similarly, power generation, you see very similar trends again. But when you move to the demand side indicators, for example, car sales, right? That's a high frequency indicator available. The car sale collapsed 97% in April. And what we are seeing in the data in May is not much improvement. It's still minus 87% down. So I think the discretionary demand in the economy is slow to recover, partly for the obvious reasons, consumer sentiments and so on and so forth. But the production side, which is cement production and industrial production, and those started to come off a little more rapidly compared to the demand side right now. But what is also important, I think, in the whole COVID situation, there are only two moving parts as I see it. One is the infection rate / lockdown, and second is the macroeconomic policy response. Between these two, the ultimate cyclical rebound will be shaped, right? And as I said, economy has begun to open up. We still have high infection rates, but let's just see if we continue to open up, then I think the production side is coming very rapidly. The demand side will be much dependent on the policy response. Now, a word on the policy response, we've already heard a lot from the central bank, RBI, and also a number of times from the government as well. If I have to kind of judge the policy response, then I think on the monetary side, I think RBI has done a pretty good job, not just in terms of cutting interest rates very rapidly, but also injecting liquidity into the system at a very rapid pace, right? So what we are seeing is that the short end interest rates in the economy have collapsed to, multi-decade low, right? Today, 3-month T-bill of the government of India is trading at all-time low. And liquidity conditions are fairly easy. What we are still waiting to see, it's happening gradually, but not to the extent that we would have liked, which is that the long rates have also come off, just that it is somewhat slower than what one would have liked. Although we do believe that over the next couple of months, we also see long rates coming down and transmission happening to the lending rates and corporate bond spreads much more aggressively compared to what we have seen so far, really. Now, what we're also seeing from the government side is two things. One, government has provided credit guarantees to the MSMEs. And this is, I think, a very important part, because medium and small enterprises in the economy are very, very important part of the demand. They employ a large chunk of people, but also they contribute 40% to exports. And over the last 3 or 4 years, they have been on the receiving end of it, which kind of creating a job problem in some sense. So what the government has done is government has come out with a credit guarantee program so that the banks are not reluctant to lend them, and that it's a 4-year money which helped them get to the other side of COVID-19 without being forced into unnecessary bankruptcy. So I think that was a very crucial step which the government has taken, and banks should be ramping up credit lines to some of these smaller businesses, which also helps, by the way, the employment situation really. The second thing which the government has done is, from the near-term perspective, is that they have initiated transfers to the households, particularly, fulfilling the humanitarian needs of food and basic needs. But here, I feel that I think more needs to be done. I think the fiscal response so far has been somewhat underwhelming, given the fact that economy was weak even going into COVID-19, private sector was weak even going into COVID-19. So we feel that while RBI steps are extremely helpful, but I think if they're complemented with a little more aggressive push on the fiscal side, I think the effectiveness of the whole is going to be much more than we are currently seeing. So I would say that monetary side, very good response. Fiscal side, some elements were quite desirable, but I think the spending ramp up needs to happen. Remember, in the US, what we are seeing is because of this, this merger or alliance between the spender of last resort and lender of last resort has really transferred the money to the households very, very quickly, which is showing up in very rapid increase in the money supply and personal income. And that just gives a lot of confidence to the households and businesses and to the financial sector in terms of their balance sheets. And therefore, as the economy opens up, the demand indicators can ramp up a little more faster than otherwise. So in India, that same thing needs to happen a little more bigger scale, in my view, so that the households are in a shape to actually ramp up their spending ways as the economy opens up, really. Now, coming to the medium term in interest of time, so if you look at the cyclical bounce here, very short term over the next 1 year, we are expecting some contraction in the activity in F21, which is about -4, -5% kind of a contraction, which is understandable given the lockdowns. But subsequently, we think that if we get another push on the fiscal side by another 2 to 3 percentage points of GDP, I think the recovery in F22 can really take hold. Remember, by that time, the global economy should also be bouncing, provided there are no resurfacing of infection rates across the world. And if that happens, then exports tailwind would also be feeding into the domestic demand story if we get the fiscal deficit spending going, really. Else, what we'll see that suppose another fiscal deficit fails to materialize, in that case, we would have to rely more on the export cycle first before we can get a bigger credit cycle in the domestic economy, really. So in that case, the recovery over the next 1.5 years would be somewhat slower compared to the otherwise, really. That brings me to the medium-term story, which is 3 to 5 years out, where we are saying that some of the structural factors start to dominate when we are talking about medium-term uptick in the economy. And there, India's story is much discovered, which is, I'll put down at least 3 factors which come to my mind from the medium-term perspective. One is the demography, which is very well discovered. I'll not spend much time. India has another 15 to 20 years of very good demographic trends. Now, what we've seen historically across countries, periods where economies are going through a good demography, the investment to GDP ratios tend to scale up. Now, this is not something which is a given or destined for sure, but this is something which is a very big advantage if one can make use of it. So we saw that in case of China and Japan. If you play out the investment rates with the demographic trends in China, Japan, and other countries, they very much coincide with the periods where demography was very good, whereas investment to GDP tends to taper off during periods where demography is slowing down. So India is very much on the right side of that divide. And what is also as a second factor, which I think needs to be seen in context of demography, is that India's starting point of debt to GDP, particularly private sector debt to GDP, is very low. Right? It is well known that India is going through a cyclical credit cycle downturn over the last 4 or 5 years, which is now stabilizing. But from the medium term perspective, credit to GDP at 60 to 65% for the private sector is low relative to the comparables. So in other words, what I'm saying is that if you take the two things together, which is the starting point of demography is extremely good and starting point of debt to GDP is not very high, then typically these two tend to form a good springboard for the economy to bounce back over the medium term, really, particularly investment to GDP ratios. So whereas the countries which are on the wrong side of this, where debt to GDP is high and demography is somewhat on the declining side, I think typically it tends to add up to slowing growth trajectory in the economies, really.
You have 1 minute left.
Yeah. So just as a last point, the third element of the medium-term story of India is obviously deregulation. Some of the reforms I've mentioned, GST and tax reforms and so on and so forth. But what is most exciting to me, what has happened over the last 4 or 5 years is this, this is somewhat underappreciated, and therefore we want to emphasize this, that a mark of a modern economy is whether the government has a good capacity to collect taxes without leakages and whether it has the capacity to spend those taxes very efficiently. And what India is seeing in GST and direct benefits transfers, one is a mechanism to improve tax collections for the government and broaden the tax base. And second is spending more effectively and better in a better targeted way, really. So I think these two reforms, which is on the tax collection side, as well as on the spending side, makes India's government really, the Indian government really comes of age in that sense, much suitable and required for a modern economy, that government can run its functions of collection and spending much more efficiently. So in one line, just to summarize, I think pre-COVID Indian economy was somewhat weaker footing, although it was stabilizing. Unfortunately, we had COVID-19. Our lockdowns were quite stringent, so data deteriorations was very rapid compared to the comparables, just that it is now picking up in some of the hard frequency indicators, but mainly on the production side as of now. Demand side is still awaited. The policy response is much more stronger on monetary side, but fiscal needs to be awaited. I think there is a much need of a ramp up in the fiscal spending, really. And from the medium term perspective, I particularly feel that demography, debt, and deregulation, which is going on in the Indian economy, I think places India on the springboard for a higher growth trajectory once we are out of this cyclical downturn. Thank you very much.
Thank you very much, Kapil. I think you provided a great overview and set us up very well for the rest of the webinar today. We will now start with our first panel discussion on FPI issues. I'm Laurence van der Loo. I'm Director Tech and Ops at ASIFMA, and I will be your moderator today. We have a very distinguished panel set up and lined up for you. So today we have Abdelhamid Bizit, who is head of iShares product platform and markets at Asia Pacific at BlackRock. With him, we also have Rajesh Gandhi, who is partner global business tax at Deloitte. We have Jyoti Rai, who is head of channel partners and alliances at Edelweiss Asset Services. And last but not least, we have Vaishali Babu, who's associate director, head local product development and market intelligence at BNP Paribas Securities Services. And Vaishali is also one of the co-chairs of ASIFMA's custody group in India. So it's been thanks to Kapil who set us up very well. It's obviously been tumultuous times for international investors and Indian markets alike. And there were a lot of positive developments in 2019 to attract FPIs, but it will be interesting to see how the impact of COVID-19 and the extended lockdown plays out. So today we will discuss some of these recent developments and what else global investors will need to see to grow their investments in India. So Abdel, I'd actually would like to start with you, and it would be great if you can share your view on what has been the impact of COVID-19 and the Indian lockdown on FPIs, and specifically how BlackRock is currently looking at emerging markets and India specifically at the moment.
Thank you very much, Laurence, and thanks everyone for listening in. So if you look at an offshore investor perspective and how we look at EM and India in general, then I would say that we are reasonably cautious. We saw a lot of investors going out of EM due to the crisis in the first 3 months, and India was part of it. Now, over the short term, what we see is that there are definitely certain tailwinds associated to the recovery from COVID-19, in particular in East and Southeast Asia, which makes us quite positive on those markets in particular. And India may benefit from those tailwinds. However, India has also still a situation where there is still some lockdowns, and the fiscal policy, which was raised by Kapil first, is a cause of concern, and that could create a deeper recession and slower recovery than the rest of the market. On the fixed income side, I think that the main challenge that we saw is related to the Franklin Templeton recent crisis, which probably would be talked about a bit later in the fixed income panel. This was not well received by some of our clients, and they have been quite cautious investing into Indian fixed income following that. In particular, since the RBI has now still limited room for further rate cuts. So while there are definitely certain positives, in particular on the fixed income side, related to the implementation of Euro-clearable bonds, which could mean that there is a path to inclusion of Indian govies into global indices. There are also certain challenges investing into India, and the Indian government should definitely think about how they will facilitate offshore investments, both in equity and bonds first, to bring offshore investors' confidence back.
Thank you very much, Abdel. And you're right. So we will have a fixed income panel later this afternoon that will touch in a bit more detail on some of the issues that you just raised. But thanks for setting the scene. So Vaishali, perhaps over to you as one of the custodians on the ground. Really, what have been the practical implications on operations and investment channels, etc., from COVID-19? What have you seen?
Yes. So thanks. Am I audible?
Yeah.
Yeah. So thanks, Abdel, for setting up the global view. Having said that, at the ground level, what we see is that the regulators have been very, very proactive. Unlike the previous crisis, they have been at the forefront to deal with the topic. That's the point number one. Secondly, they have been trying to build the infrastructure which is having the long-term impact. Actually, they're not really looking at spontaneous corrections, and that's the good point of it. Let's look at it. What are the practical implications point of view? The one thing which has been really, really of help is the common application form, which has really gone live as of January 2020. But this has really coincided with our COVID times, and it has been of great help for the FPIs, which is a very automated way of having their PAN, having their FPI registration, as well as setting up their cash and the securities account. So it has been a boon, a help in this COVID time. So full credit, I would give it to the regulators in terms of being really thinking ahead of the time. The second thing, having said this, the one thing which SEBI really came out very much in time was acceptance of documents on scanned copy. Okay, this has been again of a great help. Now this has been given the concession till 30th June, and looking at the lockdown situation, maybe there will be something more extension to it. But as of now, this has not stopped the entry of the foreign investors in India. And that's the key point to take. Looking at the debt, actually the debt is the flavor of the season, and the voluntary retention route is again an attractive portion to it. They have given the concession of additional 3 months for your 75% that the FPI is supposed to invest in India. So normally the wording was that the 75% investment needs to come within the first 3 months. Now additional 3 months extension has been given, and this has been really helping, practically helping all FPIs to put in their strategy to look at India overview. And last, it's been a very small thing, but, reporting, what there has been certain regulatory reporting concessions. So there has been less pressure on the FPIs from the point of view of non-compliance. So, regulators have been really, they have been very pragmatic. They have been very practical. This is what I would say today.
Yeah, thanks, Vaishali. And that's indeed that pragmatism and fast provision of flexibility by the Indian regulators was definitely very much welcomed by the FPIs and the wider community alike. And Rajesh, I think there's been some other immediate regulatory responses following COVID-19 and the lockdown. What else can you share with us? What else has been happening?
Yeah, Lawrence, good afternoon to everyone, and pleasure to speak. So taking a cue from what Abdul and Vaishali mentioned, there has indeed been some key relaxations in the regulations which have positively impacted FPIs. So to start with, Mauritius funds will now be part of category 1, which helps them from various perspectives. It helps to reduce their KYC requirements. Mauritius funds can now participate in the P notes or ODIs, which earlier they could not do as a non-FATF based category 2 investors. And more importantly, Mauritius funds will no longer have to bother about the indirect share transfer tax, which was one of the biggest reasons why Mauritius was trying to push the Indian government to say that they have all the systems in place, they are a well-developed economy, so they should get the category 1 status, even though they're not a FATF member country. So I think that was pretty positive, especially for a lot of India-focused funds, which were impacted by this indirect share transfer tax. I don't think any other countries which are non-FATF members, maybe like Cayman countries in the Middle East, might get the benefit of this anytime soon. I don't see any announcements being made, but Mauritius for sure has got some benefit there. The second thing, again, which has been positive is the new FAR, or the fully accessible route for debt investments in government securities. A couple of unique features there. This is a route which is available to all non-residents, not just FPIs. And under this route, you can now invest for the first time through an overseas depository. You don't have to invest to an Indian depository. And there are no caps, no restrictions or ceilings on investment. So I think all this is pretty positive. And the only thing it does is it covers limited kinds of GSECs like the 5-year, 10-year, 30-year investments. And all the existing investments also move to this new regime. So for those investors who had the benefit of the GSEC, will now have 1 year to reject the investments to comply with the conditions under the old route. Similarly, on the stamp duty, the government has gone ahead and implemented from July 1, a uniform stamp duty across the country. I think this is again going to be, in some sense, positive, I may say, because it makes stamp duty applicable on a uniform basis across the country. And recently, the Gujarat government, in fact, has issued a notification to say that they will be refunding any stamp duty which brokers who are based in the gift city will have to pay. So that's on certain recent changes. A couple of things on COVID. Well, the government has not given any tax relief or reduction in tax rates, because I think the government, as Kapil mentioned, has their own pressure in terms of revenue collection and stuff like that. But what they've done is a couple of compliance-related relaxations. One is to say that return filing deadlines will move from July and September to November 30th for all kinds of taxpayers. And second is, as Vaishali indicated, that you can now give your scanned copy of documents for new registrations, for KYC refresh, etc., which earlier you had to give physical copies. Back to you, Lawrence.
Yeah, thanks, Rajesh, for that great overview. So, yeah, so Jyoti, you're obviously talking to an enormous amount of FPIs every day. So, yeah, how has all of this been perceived by them, by your clients? Jyoti, you have to take yourself off mute, please. Thank you.
Thank you, Lawrence. Thank you, ASIFMA, for having us participate in this conference and having me on this panel. I think a very good preview has been laid out by Abdul, who is representing the investor from the offshore perspective, has given a perspective based on the, which is cautious in nature, based purely on markets and economic parameters. And my colleagues and on the panel, industry colleagues on the panel have given a further elaborative spectrum of what ease of documentation relaxations has happened during this time, and all of these relaxation, or you may call these as relaxation or concessions, has a very important role to play. Let me divide this into one. For existing FPIs, relaxations like stamp duty, or you may say, with regards to documents being can be now we can process these documents on scan over emails, and other relaxation with regards to VRR are a very important important parameters for existing FPIs. When you sum this all up for fence-sitter FPIs, which are yet to take their licenses and they are contemplating to whether enter Indian markets or not, these all relaxations and flexibility really helps in for us to change the perception that, one, that we are an easy market to access. We are no more perceived to be a difficult market to access. And second thing, this really encourages large global asset allocators to shift their investments in a meaningful way to India. While these are all neon green, so to say, in the list of hedge funds contemplating to enter Indian markets, what is also important for perception setting is our stand on prolonged uncertainties, which are usually not answered. So two things again. One is that during this COVID time, the regulator has taken time to kind of, ease the whole process and has been quite practical, as Vaishali mentioned. And Rajesh mentioned about how this time has been utilized to kind of give clarity on plenty of other things that goes along. I think the most important one he mentioned was clarity on geographies. And with regards to the prolonged uncertainty, which was there around Mauritius, which has been one of the geographies from where the funds has been coming into India, both in listed and unlisted space, faced a lot of challenge precisely because of that. But I think great that the regulator took the whole thing into its hand and gave out a clear message that that it's an eligible geography, and FPI wanting to take license 1, category 1 license coming from Mauritius will be eligible. I think all of this collectively clears up a lot of air, and these are heavy weights when it comes to perception setting. So I completely echo what has been shared so far, and this is what I would like to say, that we are no more a market that has been perceived as a difficult market to access. I think this is really behind us in a very meaningful way.
Thanks, Jyoti. And we actually have a question from the audience. So because that's a lot has happened, but it would also be interesting to see what else is on the horizon. So we actually have a question from the audience for you, Rajesh, around the development in respect of streamlining the NRI, so the non-resident Indians, and FPI routes, and anything you can share in terms of updates of that proposed framework being designed between the regulators and the stakeholders. So anything you can share on that front?
Yeah, sure, Lawrence. So I think this is something which came up in the finance minister's speech in the budget in 2019. And I think after that, SEBI has been working in creating a route for the merger of the NRI-PIS window and the FPI routes. I think work has been done around that, and we might soon see some announcements in terms of which NRIs could be deemed to be FPIs going forward. I think SEBI has been very careful to ensure that NRI as a community, which are individuals, are not adversely impacted by the host of regulations which apply to FPIs and institutions. So I think that sensitivity will be carried forward. But I think what will be also interesting to see whether NRI-owned funds are also allowed to register under this route. Because if you remember, NRIs can only come as up to 50% for all NRIs put together and 25% for a single NRI in the current regulations. But with the merger, there is an expectation that 100% NRI-owned companies would be allowed. I think we'll have to wait and see for that. What happens to that?
Thanks, Rajesh. That would obviously be very much welcomed by these funds and the NRIs alike. Vaishali, anything you would want to add in terms of other developments you see on the horizon?
Yes. So in terms of, again, the GSEC, compared to the March CCIL, which is the CCP for the government securities, have put in the rules for the margining, there has been heavy discussions with RBI whether these margining rules can be relaxed for the FPIs. So we are trying to promote the same way on the equity side, how the early paying facility is there, whether we can facilitate the same or the same approach for the government securities. Again, I'm taking the clue from what Jyoti said, ease of doing business, okay, without compromising on the risk factor. And also, we are also trying to do whether GSEC can be confirmed or can be reported on instead of T-day with the T+1, again, with the help that it should be ease of doing business. So I think these are the two things that we industry are working on. Thanks.
Yeah, absolutely. Thanks, Vaishali. So Abdel, perhaps over to you. So there's obviously everything that everybody has just been sharing. So a lot has been happening and is on the horizon. But really, what are the things that BlackRock really needs to see to grow your investments in India? What are really the key remaining pain points that you want to see resolved? Your wish list.
Well, yes, thanks, Laura. So I think BlackRock is a big indexed provider. Right, so we create exchange traded funds and we invest into India with that in mind. So some pain points. Hello, can you hear me? Yeah, sorry. So some pain points which continue are related to CGT. CGT on bonus shares and FX funding, which was just mentioned by Rajesh. Obviously pain points which remain for us because we try to include India into portfolios, and India is differentiated from other countries in that regards. So that creates divergence in performance, complexity in replication, and so on. There are some new pain points which I guess will also be mentioned by other panels, which relate to COVID and for instance, the shortening of trading windows for FX and bonds, which is a big pain point for offshore investors. And a new one came up also quite recently related to how the tax treaties can be recovered in terms of, for instance, dividends from corporates. So dividends are taxed, but how do foreign investors can get that tax back based, or part of the tax back based on the tax treaties that India has with certain jurisdictions. So all those are elements which are a bit challenging from an investor perspective and which put India in a slightly unfavorable place, even within index products. Foreign ownership limits hasn't been fully resolved. India tried to resolve it, but they haven't been resolving that entirely. Now, those are relatively small, but it's important to restore investor confidence.
Yeah, absolutely. And thanks for sharing those, Abdel. Perhaps Millie, I would like to seek the view from the audience. So can you please show the polling question, please? Thanks. So yeah, we'd very much like to seek the view from the audience. So please participate. So the question is, what will be the biggest driver of further foreign investment in India? Economic growth, tax clarity and tax regime in line with international practices, further smoothing of the FPI access channel, gift city developments, or others. So while people are responding, perhaps Jyoti, I'd like to seek your view again on really what you have been hearing from your clients in terms of really the key issues that they would like to see resolved to grow their investments.
Sure, Lawrence. So again, with regards to allocating fresh funds into markets, or altogether global allocators wanting to shift a larger chunk of their assets, depends on multiple reasons. One being the economic growth being on track, or macroeconomy, plus the interest rates and stuff, which I'm sure the next equity panel where Shiv will be speaking will do more justice to all of that. But one of the some of the key aspects which goes extremely becomes very relevant for these global funds or global asset allocators, which are doing multiple markets. Some of the things that weighs pretty high on their list of which they have to be striked correct, are the ones besides ease of access, which I spoke, and my co-panelist spoke. The other things which are must and necessary for any geography which is receiving funds from these global funds is, first is consistency and clarity in the regulations, which I believe the regulator has done a great job. With regards to the second most important aspect is like smooth trading experience, both operationally and clearing and so forth. Third is, and most recently, which I have been hearing from my partners ecosystem, which is spread out globally, and their clients, and is that fungibility of products, exchange listed products. These global allocators don't just invest in equity, they go beyond equity asset class. We spoke about debt being the flavor, as Vishali mentioned. These allocators are investing in debt, they are investing within debt, they are investing in security receipts, they are wanting to invest and pick up state sovereign bonds, and so forth. I think the whole basket needs to be made available, and the fungibility has to be pretty smooth across these products. And all of this gets outlined by the clarity on taxation and how competitive tax regime that we have, which really adds up on their list. And last but not the least, that with IBC being in place, we are taking the right steps towards giving those product lines to these global funds, which are yet to come to India. And they are now scouting for information and wanting to test waters by picking up the piece of credit market in India. This is just one example. And to add further is, these global funds needs to have 23 hours market, which is made available through Gift City. And they need to have prime brokerage services for that matter, which is for pure hedge funds doing multiple strategies require time to time. I think the path that we have put out as a runway for the funds to come and start investing in Indian markets is so far so good. Collectively, on the other aspects, if those are rounded up as well, we'll certainly see lot of larger global funds increasing their allocations meaningfully to Indian markets. Over to you, Lawrence.
Great, thanks, Jyoti. And I'm sharing the results now. Can people see the results now of the poll?
Yes, they can.
Great, thank you. So yeah, thanks everybody for participating. So it seems, yeah, that economic growth and tax clarity followed by further smoothing of the FPI access channels are really, are quite close, and are some of the issues that need to be resolved. So Vaishali, what's your view? Anything you want to add to what Jyoti just shared, or any comments on the polling results?
Absolutely. I think the polling result has been very clear enough to say that, there has to be substance, and that's the growth rate. Okay. And India has always been needing the foreign investment. And during this time, it is important for the regulator, to the ministry, to keep that interest alive in India. And of course, there is a lot of wish list that we have it. And since we interact a lot with directly the FPIs, I think one of the key things that they are really looking for is, let's take an example of VRR investment. And there are certain restrictions when it is coming to unlisted debt participation by the FPIs in terms of end use restrictions, whether they cannot invest in a purchase of land or real estate or something like that, which is not there in listed. So considering that there is a commitment to the market for the debt side, can we really look at relaxing this particular bit? Maybe the other point which I would like to, though it is not exactly FDI, but FDI, foreign direct investment, is again a very important part for any infrastructure building in India. And in this case, the way SEBI has gone ahead with acceptance of documents on scan copy, but nothing has really we have heard from RBI with respect to FDI. So, there have been the requests from the foreign investor community whether something can be done about it, in the interest of, moving ahead, continuing the momentum of investment. The other thing which I think there has been an announcement by the finance minister in the government speech, in the budget speech about the FPI to invest in debt issued by the REITs and InvITs. Again, I think this is one sector which has still done well despite the slowdown everywhere. So FPIs, whether they can review at them participating in the REITs and InvITs, so that would be some of the key things that would really spark the momentum. And regulators have been hearing us positively, and let's hope to hear something really good from this. I'll pause here.
Thanks, Vaishali. And a brief follow-up question, just a short one from the audience is really, so there's been some outflows over the last couple of months, but which country or countries have shown the highest investments coming into India over the last couple of months? Is that something that you would be able to share?
Okay. Overall, of course, these are not a very publicly available information, but the way the grapevine says so. So there has been, yes, there has been a lot of outflows, especially on the debt side and and followed by the equity. But I think most of it is from the US. This is what we get the perception about it. But yes, we are if the latest figures if we hear, there is a positive momentum.
Sure. Okay. Thanks, Vaishali. And then Abdel, a follow-up question for you from the audience as well. You touched upon it earlier, but so there's been a recent change of increasing FPI limits and merging them with the sectoral limits since the 1st of April. So how is it impacting the inflows, and how have these changes in the limits and the merging them with the sectoral limits, how has this been perceived by the FPIs, and are these really fully operational now?
Well, that was actually one of the issues that I mentioned. They are not fully operational, and the reason for that is that it is still voluntary. So the companies still have a choice to apply certain limits or not, and that means that you end up in a situation where, from an index perspective, the index providers cannot use these new limits and these new relaxations. And if it doesn't become voluntary, then that would allow for further inclusion. But as long as it's voluntary, there would be no real impact on indexed investors.
Thanks for adding that additional color. And then last, one of the last topics I want to touch on today is really Gift City. So it has come up earlier, and actually we have a question from the audience on this as well. So perhaps Jyoti, how do you feel? That's a question from the audience. How do you feel that innovative products being lined up at Gift City, at the International Financial Service Center, how do these products play a vital role in the capital market space? And then the ask from the government to really make the IFSC, the Gift City platform, a catalyst for global investors. What's your view on that?
Sure. Before commenting on the product innovation, which is certainly underway at Gift City, I think Gift City, we need to understand from a larger perspective, especially we are speaking about offshore investments into India. Gift City is a very ambitious project announced by Honorable Prime Minister, and with a view to that we've been a prize taker for far too long. We need to be prize makers market too. I think with that underlying message, the regulators have come together, and three regulators, all three heavyweights of our country, SEBI, RBI, IRDA, have come together to lay down the foundation. And today, as we sit today, I think some of the remarkable or path-breaking developments that has happened specifically in last few months and few quarters has been IFSC Act is amongst us. What it does is that irrespective of whichever government is there in the center, this act will is a grand finale. And the kind of a regulations that is needed for smooth functioning of IFSC is laid out in this particular act. Sooner the key positions will be filled up. I've been told in next 2 to 3 months the key positions are getting filled up. When that happens, the unified regulator, which is already in place, will take over the necessary regulatory regime realms of safeguarding the entire process regulations at the GIFT City, which is a huge development, so to say. Besides that, whenever I have collected the overall feedback from various hedge funds I have met during my roadshows or their representatives, which are service providers, I think they have given a thumping yes for GIFT City already. So it is not that it is yet to take off. Yes, there are certain aspects that are in the process of which are getting evolved at the moment. But I would like to tell you 3 key things which I have received in terms of my polling with regards to GIFT City. One, hedge funds were saying that you give us a dollar traded and dollar settled market. Okay, give us a market which starts at the Tokyo time and ends at the US time, which is predominantly 23 hours market. A unified regulator and any dispute settlement, securities act in the local geography for us to kind of get through any challenges or disconnect with many market participants. All this is there today in GIFT City. Besides that, foreign funds coming over, I think Stancy just recently opened a branch there. Besides that, the OTC product made available by the bank, which is predominantly been dominated by foreign banks, is a huge product pipeline in the making at the GIFT City. So it will be made available to the market participants through GIFT City. And the Indian banks are taking lead in that. We can't forget that we recently had a very successful launch of rupee dollar trading contract, FX contract, and that itself is gonna onshore a lot of volumes in that space. So all this put together, you can see that the GIFT City is truly an ambitious project, and both the exchanges, besides the regulators and the PMO office themselves through their task force, is doing the necessary to kind of build this up further and to put this at par with any global financial center for that matter.
Great,
So,
thanks, Jyoti. We're running out of time, so unfortunately, I will have to stop you there. My hope is that at one point we will all be able to safely travel again, so I can finally visit GIFT City over the next couple of months. So we need to bring this panel to a close. So thank you very much to our distinguished panelists for sharing your views. There were some questions from the audience in relation to the recent rating downgrade, which I'm sure my colleague Rebecca will address later in the fixed income panel. So please stay tuned. But first, I'm gonna turn over to my colleague Lyndon, who will introduce you to the panelists of the equities panel. Lyndon, over to you.
Thank you very much, Laurence, for that, and thank you for the prior panelists for a very interesting session. As Laurence mentioned, I'll be kicking off the equities panel, and today I'm very pleased to be joined by Arvind Maheswari, who is the Managing Director and Head of India Sales Trading for Merrill Lynch in India. I'm joined by Shiv Sehgal, who's the President and Co-Head of the Institutional Clients Group for Edelweiss. I'm joined by Harry Kay, who's the Chief Business Officer for the National Stock Exchange. And I'm joined by Kashar Surti, Director of UBS Asset Management. So thank you all for joining us today. Today we're going to be going through some high-level themes about how India is continuing to reform its markets to attract global investment as it emerges from COVID-19. What are some of the key market and regulatory developments in 2020? What do investors need to see to grow their investments in India? And how do developments in India compare with other markets within the region? We're going to try to not overlap too much with the content previously covered. So I note that Kapil covered quite a lot in terms of the economic backdrop to COVID-19 and how India is emerging from that. By the way, can I ask those of you not speaking to please leave yourselves on mute? That would be most appreciated. So maybe Kapil covered the economics angle quite well, but perhaps Harry Kay, the Chief Business Officer for the National Stock Exchange, a good partner of ASIFMA, could maybe comment on what he has seen in terms of the extreme market volatility in COVID-19, and what has the NSE been doing, in particular in terms of working to regulate the markets, make them help the markets become more robust, and help India emerge from COVID-19. Perhaps I turn over to Harry K to kick us off. Harry?
Hi, thank you. Thank you for having me here, having NSE on this panel. So, what we have seen, as the previous panelists has also covered, that the regulators have really done a lot during this time. For example, most of the regulatory filings have been postponed. They've been given some time for filing, and even the penalty for the late filings have been waived off. And in fact, SEBI has reduced the turnover fee by 50% from June 2020 till March 2021, which is again 50% of the fee has been waived by SEBI. And as Vaishali in the previous panel also mentioned, FPI processing for documents have all been simplified. Yeah. And one of the key things from the market perspective is working from home for trading members and clearing members, which was a big concern, which was also relaxed. So it gives us to an interesting question that even if at some point of time you want to extend the derivatives market, say the indices, one of the concerns was how do people access the market during late hours? So that becomes a little easier in the current circumstances. So definitely, a lot of regulation changes has happened, which we can see. And what is another important thing from a very market perspective? So what we are seeing is that the cash market volumes in the last 3 months have increased about 23%. We do it roughly about 7 billion US euro every day in the cash markets. And the derivatives market as well has increased by about 15 to 17% volumes exceeding, which is very interesting. And one of the new things what you heard is the number of new investors, 1 million new investor registrations in the last 3 months. So the new investors, a lot of guys, maybe guys who have not been trading before, looking at the market, they have time now at their hands. So we have seen a lot of new investments coming. One of the very important data point, which really will be in context, is that the trading from mobile trading and internet trading, which used to be about 23-25% before, is now gone up to 35% in the last 3 months. So there are various things which has happened. So what as an exchange, what we have done, we've used this time very effectively to talk to the market, and also reach out to them to see what best we can do in this time. So the best thing what we have done is to help them tide over the situation by relaxing the compliances from our side with the great cooperation from the regulator, and also from our side we've given them as much responses which they could easily. From a listed companies perspective, we've reduced fees for SME companies. So overall, we have seen a lot of relaxations by the regulator, which helped us to also ease out things. And a couple of new products which we have introduced is we've introduced gold options from yesterday. Yeah, we've introduced gold options on NSE from yesterday. We have introduced interest rate options recently. And as my previous speaker also said, in the GIFT City, we have introduced FX contracts. So by and large, even though we've not done a lot of innovations at this time, but we have done a lot of facilitations.
Thank you, Harry. Certainly, you've been a very strong partner to us and to the industry. We work together to ask SEBI for increased flexibility to allow people to work from home, which is critical to continue servicing clients, servicing the inflows into India whilst minimizing health risks. So thank you so much for your partnership on that.
Thank you.
With respect to the market impact, I wonder if I could turn now to Shiv. Is there any additional color that you might want to share with respect to what you saw, during the past few months amidst COVID-19 and what you're seeing now as India emerges from COVID-19? Shiv?
Sure. So first of all, a very good afternoon to everyone, and thanks for dialing in. I think Hari mentions out, some important stats there. I'm actually not surprised to see the retail participation, kind of increase as what we have seen in the US with the Robinhood trading and stuff, 1 million new accounts added. I think let's not forget that there are a lot of industries which are still shut. And, India had the most prolonged kind of lockdown in terms of any emerging market, especially relative to the size that we are in. If I could just take a step back and give some more color to everyone dialing in as to what happened in terms of flows that we saw, especially from an institutional perspective. So what happened in March when the puke out in equities was happening, right? I think, and the data shows that it was the foreigners who kind of led the first round of leg down, right? Most of the foreign institutions led the selling narrative, which was also then triggered by the fact that given the velocity and the veracity of the sharp sell down, and Nifty at the bottom was down almost like 33%. A lot of stops from hedge funds also got triggered. A lot of the petro dollar long onlys also got some redemptions, which kind of exacerbated and accelerated that process down. So the narrative that started with foreigners selling, we also had on the flip side, the domestic slowly nibbling in. It was probably led by the mutual funds. But once the stimulus measures came out from a global perspective, when the Fed and the BOJ and the ECB started reacting, and those are pretty big numbers in terms of stimulus, and we all know them. The reality is that in April we saw the mutual funds kind of taking a step back, but in India we kind of bucket domestic institutions in mutual funds versus insurance. And in April we saw April and May, specifically the insurance guys who were sitting on a bit of more cash than mutual funds come back and nibble back into the market. So I'm not surprised if I were to look in terms of data, right, year to date. We have had foreigners selling just in secondary markets alone in India about $5.2 billion. But on the flip side, we have seen domestic mutual funds and domestic institutions input or see inflow of almost $10.8 billion. So it's almost like a 1-to-2 ratio. The only caveat to that, I think, and the data just came out 2 days back in terms of mutual flow inflows into the industry. We were been running a run rate about 1.2 to 1.5 billion dollars inflows into mutual funds. That run rate has actually slowed down in April and May from $720 million to $600 million in May. I think there is a bit of concern in terms of how that trend looks forward. I think most of the foreigners have been looking at that flow for the last 3 or 4 years, and it's actually been quite robust. Also, I would just want to say that globally, what is happening is a lot of market participants, especially on the retail side, and the momentum players are extrapolating the sharp bounce back in equity markets with the fact that once the economies open up, the real economy is going to be fine as well. But I think there is, from the smarter money, there is skepticism around that. And I think as India opens up, we will also kind of face the demand challenge versus the supply chain issues that a large economy like us would do. And let's not forget that we also have a extended issue with the millions of migrants that have gone off from densely populated areas in cities like Delhi and Bombay to getting them back into factories and manufacturing and service industries is going to be a challenge. So I think we are in the we had the sharp sell down, we've had the bounce back in the rally in markets, but I think as economies open up is when the real challenge will come, and that's when markets will gravitate towards implying what is actually factored in the prices.
Got it. Thank you very much for that, Shiv. And it's certainly very common trends we see around the globe, as you and Harry mentioned, the retail inflow, not only in the US, but also in India and also in Korea as well as foreigners exited. So very, very consistent trends across the region. If I could turn now over to Arvind, what are you hearing from your client conversations? Any additional color you'd like to add to what Shiv just mentioned just now? Arvind?
Hi, thanks, Lyndon, and good afternoon. I presume you can hear me?
Yes, we can hear you, and we can see your handsome photo as well.
Thank you. Just, I don't want to repeat what, Shiv has made some really good and valid points. So just to add a little bit of context from an emerging markets equity standpoint, so emerging market equities, I think, have seen almost a record $90 billion of outflows in 2020. and that equates to nearly the same amount that we saw back in the GFC time in '08 and '09. 14 weeks of emerging market outflows in 2020 equate to nearly 72 weeks of outflows in '08, '09. So, I think India needs to be seen in the context of what we've seen in emerging markets in general. I think given the huge outperformance by the US markets, I think, you saw a lot of money move to the US equity markets. And I think now with the dollar weakness very recently, some bit of outperformance is coming back into Asia. And India should see a spillover benefit from that. I think India, a lot of investors have been caught rethinking now their underweights in Asia, in emerging markets, and in Europe as well, outside of the US. So I think this trend, while very early to call this as sustainable, but I think you will continue to see more and hear more noise around this going forward in the near future. Overall, I think in terms of client activity, India has had the fortune of being one of the few markets where you've had a very healthy inflow coming in through either primary or secondary deals. But you are seeing a good pipeline of capital market transactions, which has meant that India is actually one of the rare markets in Asia where you have seen net inflows from foreigners this quarter. In the June quarter, it's a net positive number, which is quite a surprise. And Shiv mentioned earlier, a lot of the other markets across Asia have seen outflows. So incrementally, I think there is demand for quality assets. All these deals that got done were hugely oversubscribed. Even the bigger ones got hugely oversubscribed, and we had investors clamoring for more. So I think this will continue to remain the theme. If there is good quality assets there, liquidity is, the markets are so flush with liquidity right now, given the big stimulus packages across the globe, that you will continue to see a chase for these assets. And anything that happens which is constructive for emerging markets, I think India will definitely be one of the beneficiaries. That said, obviously we are cognizant that these are troubled times and things can change very quickly. We have to obviously keep a watch on what's happening with the COVID situation in India, and hopefully we are at the peak right now.
Yeah,
over to you, Linda.
Very much. Thank you, Arba, and thanks very much for that color. And it's good to see things beginning to normalize. Although, as you say, the COVID situation in India remains still relatively elevated, but we hope that goes back, reduces back to normal as well relatively soon. I'd like to turn now to Kashaya for a quick moment. I know, Kashaya, you mentioned that you manage both active and passive funds. Abdul earlier kind of gave us his glimpse with respect to how he's looking at emerging markets across Asia. I wonder if you could share with us how you're looking at the markets. Do you see things normalizing? What is the smart money saying? What is the passive money saying? How are you eyeing India, and how do you assess India relative to other markets within emerging markets in Asia? Kashaya?
Hi, good day, everybody. So firstly, while we saw a lot of other markets in the region either curtail hours or shut down for a few days, like in Indonesia and Philippines, India actually managed to stay open, and that was a great thing from an investment perspective. In terms of our active money, we've been invested in India for a long time and continue to keep our positions there. In terms of passive investments, we have seen inflows in India from the MSCI rebalances in the recent 3 or 4 rebalances that we've had in the MSCI, and that's encouraging. And I believe there'll be more inflows coming in after what's happened with Kotak Bank, etc. So we continue to see money flow in from a rebalance perspective. That was a concern for the market participants as China's weight was increasing. Would India lose out? And it hasn't turned out to be so. So that's fantastic. From a trading perspective, obviously, it is very different. While investments, India is one of the best markets in the region, provides you with a wide array of industries that you can invest in. From a trading perspective, there are a few things in India that we would like to see improve upon. Block window, obviously being one of them, creates a bit of a difficulty when you're trying to cross stock on your active management side, especially when there are placements. We've had instances where 100% of the placement has been slipped, which is somebody else put a bid in before the actual clients could get filled. I believe a lot of industry participants have already spoken to the regulators and the exchanges about these things. The other thing would be the closing auction, and that we have seen a lot of development on this front in the region. Hong Kong, China, Indonesia, 3 primary examples where they've introduced closing auctions, and in some places even post-trade closing. And I'm sure Indian market is deep enough and mature enough for us to experiment and explore closing auctions. That would be a great improvement for the passive investing, because right now passive investments have to buy in the last 30 minutes, as you're aware, and any kind of big blocks go through your MOC is not matched, and therefore we have slippages. So these are the 2 things from an investment trading perspective we would like to see in terms of improvement. In terms of regulations, stability has been great, and that's a wonderful thing. And I guess the more stable markets that we have, that would be a wonderful thing from an investment management perspective.
Thanks very much for that, Kashara, and I'll forgive you for kind of reading ahead in the script, because we're going to take a quick turn now and launch into some of the deeper issues which you just mentioned now, including block trading and closing auction. So I note that in the earlier panel that both Jyoti and Vaishali pointed out some pretty significant reforms made by Indian regulators in recent years, especially anchored on FPI reform. Market structure. There continues to be some market structure issues which have been an impediment to active investors getting more engaged in the Indian market, and Kashara just highlighted too. So I'd like to now spend a few minutes with our panelists, kind of engage in some interactive dialogue on each of these topics. So again, number 1 is block trading. For those of you who may be less familiar with the Indian market, India currently has 2 15-minute block trading windows, 1 in the morning and 1 in the afternoon. But the key limiting factor is a plus or minus 1% price band, which makes it virtually impossible for big institutional players to negotiate premiums and discounts to make a block worthwhile. So invariably, the block gets executed on the open market. There's information leakage, and there's significant price slippage, as Kashara just mentioned. So maybe I open it up to the floor now for our panelists to discuss, why a block trading window, why an effective block trading window with a decent price band is so important to India's markets, and what's the kind of institutional flow we can expect to entice with an effective block trading mechanism. Over to you guys. Maybe I don't know, Harry, want to kick us off?
Yeah, thank you. So block trading, and as you know, it's been a very interesting topic, and we've been discussing this for quite some time. So as you rightly said, the 2 points. One is to have a longer window, say morning 9 to 3 o'clock or 3:30, and then to have a different price band. We have taken up this issue with the regulator as well, because one of the issues which regulators also had in mind is how do you have a balance between the retail investors who's also trading, where suddenly in the block window there are 2 people who trade, and the retail doesn't get a ability to participate in the block. And while the regulator also understands that the retail comes with a different mind frame, and the long only guys come with a different mind frame, but I think it's a balance between the 2. So we have been talking to the regulators to see whether we can have a much a longer window with a increased price band. As we speak, maybe something comes out from the regulator will be great. But this matter is under consideration from the exchange side and from the regulator side.
Thank you, Harry. I wonder if I could turn to Arvind to kind of share with us, what are you hearing from your clients? How much of a stumbling block is this block window against them participating more actively in the Indian markets? Arvind? Arvind, you there?
Yes.
Or Kashire? Yes. Yeah, yes, I can hear you. I can hear you. Thanks, Arvind.
Okay,
Yeah.
great. So I think quite topical that we are discussing this given the spate of capital market transactions that have gone through, and a couple of them have also used the block window that is currently available from the exchange. So while such instances are rare, given the limitations of price and time, I think it cannot be more often repeated a line, and I think we've been going to the regulator with this for almost a decade now on the block window requirements. While the regulator's point of view regarding retail investors is a valid one, and it should be considered when we are overall looking at this, I think the one thing that needs to be kept in mind is, in a lot of ways, this the crossing of blocks in the main order book can actually be detrimental to retail investors because most of these trades get done at a discount, and a lot of times, a regular investor, retail investor who's trading in the main order book, he would not even realize, and he'll be buying stock, and his stop loss gets triggered because of this block that goes through in the main book. So there are quite a few things here, and from a foreign investor perspective, this is the best way to get liquidity. Our market is not the most liquid, especially if you go down or beyond the top 10, 20 names for investors to put on size, and blocks is one way to do this. And I think it will be extremely crucial for foreign investments to be attracted into the market by having a mechanism which most major markets, I would say even some of the smaller markets, have a mechanism for and is often used by the institutional investors. So we could think of ways, for example, having like a 5% sort of reservation for retail as part of every block transaction, maybe increase the minimum size required for the block window. But I think these are some of the things that we can obviously throw in as the regulator looks at this a little bit more seriously.
Yeah, thank you very much for those very, very creative suggestions, Arvind, and we certainly look forward to engaging SEBI further on this and figuring out how to engineer this in such a way to offer a fair and level playing field to all investors in India. Any final thoughts on this topic from you, Shiv?
Yes, Lyndon, thanks a lot. My point is, right, this is probably the most nuanced topic for any institution coming into India, whether domestic or foreign, right? And it has been, as both Hari and Arvind both mentioned, that we've probably talked about for years now on this. I just want to throw in some stats that, to me, this is very basic as a sell-side institution, right? You cannot have a block window of just 1% market deviation when especially when you look at last 3 months, we have India VIX go up to as high as 80 and been steadily above 30, right? So 1% block window when markets are moving 7-8%, individual stocks are moving 8 to 10%, to me just doesn't make sense. So I think we really need to take a more broader and mature approach to this. And yes, the retail argument is valid, as Arvind mentioned, but in a lot of cases, it actually tends to be detrimental. So I think we need to take a more, and look at what developed markets have done and what other markets have done, and kind of take a lead from there as well. So that's my only point.
Great, thank you, Shiv. Yes, we in fact did some analysis on India blocks, especially in the ABB sector, and we noted that it took a price range of plus or minus 7% to capture just 90% of block trades looking back historically. So you're absolutely right. The plus or minus 1% band just does not work within today's context. Final thoughts from Kashire with respect to the current rule where block trade details get posted on the exchange website, including who the client is, the size of the block, the pricing. Are there any sensitivities from an investor perspective with having that information displayed?
Yes, it's a unique situation in India where we have to do that if you trade in the block window. So not only are you compromising the discount that you could potentially trade at, but also the fact that the information goes out immediately on T+1. So if the block that you put in the block window is not your complete size, you're actually leaking out information of potential future trades. And that's obviously not ideal from an investor's perspective. So I really don't see why this is done. I do know in markets, in Indonesia, the likes, the exchange publishes whether the seller is foreign or domestic, and that can easily be achieved. Can be achieved in India as well, instead of absolutely putting out the name of the end client on T+1 is not ideal.
Yeah, in most markets, as you point out, it's really the broker name that gets disclosed and not the actual end client. So there are ways to introduce more transparency without compromising client confidentiality.
Absolutely. And one point that I'd like to add, obviously, is now that the Indian mutual fund industry is quite mature and reasonably big and big in size, they are mostly comprising of Indian domestic retail investors. So even when these mutual funds can participate in the block windows, the domestic and retail mutual funds are benefiting their own end clients, which means that the retail investor is not at a disadvantage if the block window is introduced.
Great. Thank you very much for that to all of our panelists on a great discussion on block trading. And again, we hope to engage India regulators together with the industry on more in-depth discussions on block trading to try to figure out some creative solutions to this. I shift next to the closing auction, or the lack thereof, in India, where the VWAP, the volume weighted average price, is a composite of the trades during the last 30 minutes. Kishar, I'll stay with you on this since you were the one to bring it up. You know, can you help us understand, especially I guess from a passive fund perspective, the potential benefits to India's markets if we have an effective closing auction mechanism?
Sure. So most passive funds, as investors would be aware, are benchmarked to the close. And we have quite a lot of ETFs within the country and globally, and the passive investments have been increasing from around 7% of AUM to around 22% of AUM in APAC right now. And when they want to trade at close, you have to participate in the market for 30 minutes, which means you are actually risking your close versus your final execution over a 30-minute period, wherein you could have several news items which could move the markets. Not only that, if a big block goes through right now in the market, which it has to on the main stock market and not the block window, your price is deviating as well. So that impacts your final price that you achieve. And it's not ideal from a passive investment to keep missing your benchmark close on a regular basis. Having a closing auction would be a wonderful thing. And as I alluded earlier, Hong Kong, China, Indonesia have introduced in the past few years, and we can learn from these markets. And we can also have an additional post-close trading for additional volumes to go through. I don't think it would impact much volumes if we have an auction, as we will continuously see HFTs, etc., and retail investors participating in the last 30 minutes, except for the auction.
Yeah, as you pointed out, even China has a closing auction. Shanghai Stock Exchange actually did not have a closing auction as recent as 2 years ago, but the industry worked with the Shanghai Stock Exchange to advocate for one and to make some recommendations. And now they have a very well-functioning closing auction with, I think, most recent rebalance, the flow is in the teens. So it's a very successful case study. I'm happy to work with the exchanges and with SEBI to implement a similar closing auction in India. And any final thoughts from Arvind or Shiv or Harry on a closing auction? Okay. Going once?
Yeah, quickly,
okay.
This is Hari here.
I'll let Hari go.
Harry, go ahead.
So,
go ahead.
Okay, thanks.
Go ahead, Harry.
So closing auction, so India, what we, okay. So what have is a closing session now, where we have a 10-minute window. It's specific. That's the closing session. We don't have a closing auction. India's got a mix of participants. You know, for example, we have the long only. We have the domestic retail. we have HFTs, we have algos, we have combinations of players, which each of them contribute about 20 to 25%, and we've got a mix of participants. So when this topic of closing auction came, and when we were interacting with all the constituents, there were some of people who said that especially the HFTs and the high frequency and the other guys were saying that they might not participate in the closing auction because they don't their algos don't really are configured for that. Second, also said the last half an hour, NSE, the closing price is the last half an hour's weighted average price. So the last half an hour, you have phenomenal participation in everybody. So whether this closing auction may or may not impact the last half an hour's trading, we don't know. We need to look at it. So this topic was raised with us some time back with many of the funds. We have taken it up internally. We're doing some exercise internally, and we took some sample surveys from the market participants as well. So the feeling was mixed. Some people said they will, and some people said they may not. So the decision is not one way or other at this point of time.
Okay, so thank you very much for that, Harry. I note that we have quite a lot of HFTs within the ASIFMA membership. We're more than happy to engage them on your behalf and collect their further feedback on a closing auction in India, and happy to feed that feedback back to you to give you more ammunition to try to advocate for this.
Surely, thank you.
Okay, sure.
Thank you.
So maybe moving quickly on, because we're going to go very, very quickly through it, but I think we're quickly running out of time. How about securities lending? And any thoughts from our panelists with respect to the SLB mechanism in India? I note that the domestic SLB regime has been growing significantly year over year. But what are your thoughts on securities lending? How well does it work? And what can be done to further stimulate more participation by investors around the world? Maybe I turn to Arvind or Shiv.
Yeah, sure. I'm happy to take that one.
Sure.
So Edelweiss has been the leader in India in the SLBM market for a while now, right? I mean, I think I would be saying that, we will probably be 50% of market share. However, saying that, and, we've worked alongside the regulators, the exchanges and clients, but we have still seen a slow pickup on the inventory side with market participants. I think there has, as the market kind of slowly grew, one, there was apprehension in opening up the long inventory to this product by the mutual funds and the insurance companies. So I think what would really require this market to take off would be, I think the demand side is always there. There has been from the hedge fund community, and we have seen that. I think from a demand perspective, we are probably on a scale of 1 to 10, we are probably 7 or 8. I think on the supply side is where the market is struggling, right? And I think if with more clarity from the exchanges and more investor education in terms of the market structure of the SLBM market to the larger institutions in India, that maybe the top 3 mutual funds or the top 4 insurance companies. I think if you were to bring them on board for this product, it would be a game changer, right? And that's the progress we need in that direction. Having said that, what also happens in India is, given the fact that, we have single stock futures as an option to hedge, people just see that or perceive that to be a much easier mechanism in terms of hedging them, right? And plus you get the leverage from perspective as well. Where the SLBM market is probably more nuanced is that you have, a more stable inventory, and that is what would be required for it to really go as a product. Having looked at all, the different nuances, I think we have very early stages in India. It is a market that can grow exponentially if we get the right ingredients and the right structures in place. But at the moment, it's still a very nascent, in terms of just the thought process. So 2 things that are needed: market education to the key investors.
So no regulatory barriers to get asset management companies and insurance companies to come in on the supply side. It's more education and persuading
Correct.
them.
Okay. Yeah,
okay.
that my perception is that would really help.
Okay, great. Thank you for that. Arvind, to Shiv's point about how in India, because they have a very rich, deep, very liquid single name stock future market, how is that? How does that compare as an alternative to securities lending to your clients? Is it even kind of on par as an alternative? Are these two completely different things as seen through the eyes of your clients? Or is there strong demand for securities lending from your clients? Arben, are you there? Arben? Okay, maybe while
I think I've been muted.
Okay, sorry.
Hi, sorry. Yeah, I think my line was muted. So I think a few things, and Shiv made some points already. I think there is, 2 or 3 things really that is needed for any investor to take on and trade a product. Liquidity is one, costs is another, and operational ease. I think the operational ease is where it becomes important to continue to make changes and see what is not working. What is working in India is the single stock futures market, and it is directly almost cannibalizing some of the demand and some of the interest that would have otherwise gone to a stock loan borrow program. But that said, for both to coexist, it should not be a problem. I think there is a case to be made for both of them to flourish. This SLB segment hasn't really taken off in India at all. And one of the reason is just the cost of trading and the liquidity still make it quite adverse. So you have to definitely reduce cost of trading and then find ways in how we can better in terms of the single stock futures market. Both, one of the things is the stability of the borrow, and then maybe introduce more longer term borrow available instead of this whole 1 month role that anyway you're tied to the futures market in right now. So right now it's really a very obvious choice for somebody who's looking at SLB and single stock futures to go towards the single stock futures market. It's much easier, it's cost effective and liquid. So we need to now work on how we can make this go in the SLB segment's benefit. Maybe introduce more stocks, given we are restricted to only 100 plus names in single stock futures. We could add on more stocks to provide some depth to this SLB segment, and then look at costs as well. It's the margin requirements, etc., are still need to be tweaked to make it cost effective for people.
And costs, very critical factors, and look forward to working with you and others to try to make the SLB segment more efficient going forward. Any final thoughts from you, Kishar, on the SLB segment?
No, to be honest, being a traditional asset.
Okay, no worries. Millie, how much time do we have left? Are we out of time, or can we go a little bit further?
I think you can take 3 more minutes.
No, I just have a small point.
Yeah, sure, Harry.
Okay, I have a small update on SLB. So on the SLB side, India is unique in one way, is that SLB is on the exchange platform. It's not OTC. Second is that the clearing corporation guarantees settlement. The third important thing is in the last 18 months, the regulators have made all the derivative stock, which was cash settled, now it's physically settled. After physical settlement has come, what we have seen in the last week of expiry, last week of the month, the volumes in SLP has been good. As Shiv said that we're engaging with all the top mutual funds and the long only players to participate, because we have less lenders and more borrowers. And India, you can borrow a stock in SLB not only for a settlement obligation, you can just borrow it and then return it back. So all these factors put together, and as Arvind said, the cost, etc., all these factors put together, I think, even though we have a good single stock futures market, but we think SLB is the next big thing to happen at some point of time.
Okay, great, and we look forward to working with you to make it the next big thing in the very near future. Maybe another issue that I just like to raise in the final 3 minutes. We note, similar to many exchanges around the world, in light of extreme market volatility, some trading restrictions were put in place. In particular, a circular that came out late March, and that has just been extended to late June in terms of increased margin requirements, increased penalties, I'm sorry, stock and MWPL and the banning of stocks. Maybe if I could just turn to our panelists for their final closing remarks with respect to the latest extension to the end of June. You know, hopefully it really goes away and the markets return back to normal. But how have the restrictions impacted your business? Sorry, Rebecca, we'll get to you shortly. Final closing remarks from our panelists with respect to these trading restrictions extended until June 25th. Stock MWPL, the price limits, market-wide price limits, banning of stock, increased margin, and penalties. Any final thoughts on this?
Sure, Lyndon, I'll go for it. So I think there were a direct effect of where India VIX was trading, right? So if you go back to March, volatility was spiking throughout the global markets, you know, and in India VIX was almost at 80, above 80. So I think these measures were put in place to kind of curb speculation and curb the volatility in the markets. But having said that, we all want, but as a result of that, what's happened is market participants have suffered because your cost, as margins go up, your cost of trading goes up. And, you know, Urban made, you know, those three impactful points for the SLBM market to go up. But in a normal course of business, if one of your ingredients is cost of capital, which is your margins, is going up, that would directly limit your ability to trade. So from that perspective, you know, at the moment, I think as volatility spiked, these were necessary from the regulator's perspective. But honestly, I would be happy to see the back of them and the end of them. In terms of impacting sentiment and trading, given the fact that we have been in such a, I would say, you know, extremely fluctuating environment, and, you know, Hari made those points, opening statements on how volumes increased in cash and futures and stuff. I think we don't know the real nuance of how would that have impacted in normal course of business, but I would assume that anytime a cost goes up, your volumes would get impacted and your normal trading philosophy also gets impacted. So from that respect, I would, you know, as a sell-side institution and a broker, we would really be keen to see the back end of them if markets normalize, and I think they are normalizing.
Okay, cool. Yeah, we're certainly seeing India is not the most severe in terms of these extreme market restrictions. Korea still has a 6-month short selling ban in place. Correct. to the end of September. So end of June is just around the corner. Markets are gradually returning back to normal. So we very much look forward to the Indian markets also returning back to normal from a regulatory perspective. On that slightly positive note, I would like to thank our distinguished panelists and for the very active engagement in this interactive dialogue on these very, very important issues which we're not just going to talk about within this webinar, issues which we will actively follow up on, engaging our members, engaging NSE, engaging the regulators to try to improve the market structure in India to attract more global investment into India. So thank you very much to our distinguished panelists. I now turn over the mic to my colleague, Rebecca Weinrauch, on the fixed income side. Thank you.
Hi, I'm Rebecca Weinrauch, and I'm the head of fixed income here at ASIFMA, and I'm delighted to welcome you to the fixed income portion of our program. We are running a little bit late. For that, we apologize. We started out with some technical difficulties, so I think you can expect us to run about 10 to 15 minutes past our set end date. I'd like to introduce to you our panelists today. We have Srini Varadarajan, Managing Director, Head of Fixed Income and Currencies for India, Deutsche Bank. And we have Tim Batho, Chief Strategist of Index Policy Asia Pacific, FTSE Russell. On our panel, we plan to sort of focus on 3 questions. These questions are, what do you see as the key features of the Indian fixed income market since the onset of COVID? What is the impact of the recent Moody's credit downgrade on the Indian bond markets? And what key regulatory developments do you see for the rest of 2020? We will also have an interactive polling question during this session. So we're going to start with Srini. And Srini, if you could speak to us for a few minutes about the key features of the Indian fixed income market since the onset of COVID. We're all ears, we're interested.
Yeah, thank you, Rebecca. Very happy to be here in this call. India has been through almost now 9 weeks of lockdown. And if you look at the evolution of the macroeconomic data over the last 9 weeks, it's pretty stark. We've seen the manufacturing PMI, almost halve, under 30, go to under 30. The non-manufacturing PMI was at a handle of about 5, unprecedented in the time series of the data. We've also seen industrial production down to almost 17%. And the expectation is that the May number, which is going to be released, is likely to be in the region of about negative 45%, largely following the growth in the core sector, which is again close to about negative 40%. Our export growth in April, was again very, very low, negative 60%, even as import growth was also, pretty much along similar lines. If you look at it, even as we got into COVID, the economy was anyway slowing down, given the headwinds that financial markets were facing, really from the credit issues over the last 2 years. So we saw our fourth quarter GDP growth at close to around 3%, and the annual estimate was about 4% compared to 5% last year. So all in all, pretty stark numbers. Expectation really is that growth this financial year will be anywhere between -5% to -6%. And, a nominal growth actually for this year can actually be close to about, anywhere between -1% to -2%, unprecedented numbers that, we've not seen over the last 40 years. So obviously, the lockdown was needed from a public health perspective. And what really happened was that, the regulator essentially truncated the market trading hours, essentially for the money markets, the foreign exchange, and the fixed income markets. And that did impact the volumes in the market. We almost saw bond volumes, plummet by more than half in the month of April. Some pickup is what we saw during May, and that trend is basically picking up. We've seen this, essentially in the fixed income markets, the cash bond markets, the derivative markets, and even in the foreign exchange markets. So, even as, market participants had to kind of respond to the challenges of working from home, as well as, a truncated market hour structure. But, I think, I think all the BCP plans of all the banks have actually been tested to the hilt. And, I think the market is functioning and is slowly getting back over there. I will leave it at that.
We had a question earlier, Srini, on what on the Franklin Templeton issue that occurred earlier in the markets. Do you want to just give a little bit of your perspective on that before we move on to the next question?
No, I think markets were very, very impaired. I think liquidity was extremely impaired, and I think a lot of the impairments that you saw in the markets, especially in the credit markets, is what kind of propelled the Reserve Bank of India, to come out with a slew of measures, in terms of targeted long-term refi operations with some remissions that were provided to banks to invest, borrow from the TLTROs and buy, corporate paper. There was a special, liquidity facility for mutual funds, close to about $500 billion that was made available for mutual funds, given the dislocation in the credit markets. And, in addition to this, of course, policy rates have been cut, as as you might be aware. Post-COVID, we've seen policy rate cuts of almost about 115 basis points. And in this cycle, the rate-cutting cycle that began in February of last year, February 2019, rates have been cut by close to over 250 basis points. Even as the Reserve Bank of India has maintained abundant liquidity in the markets, we've infused liquidity of close to about 9 trillion INR, and their policy is to keep liquidity, fairly robust, to at least ensure that monetary transmission happens, and again, especially credit markets that were impaired begin to heal back, right? Hopefully, the measures announced by Government of India, really in terms of setting up a special purpose vehicle to buy some of the corporate bonds, at the margin, basically should help.
Thank you for that. Before we get to discussing the credit situation in India, if we could put up the polling question. So if the audience would just take a minute and answer our polling question, which is or are the key one or two items that Indian regulators should prioritize to attract greater international investment to the Indian bond market? We'll use the answers to the polling question for a bit of a discussion later. Now we're going to focus on the recent Moody's credit downgrade, where earlier this month, Moody's downgraded India's credit to the very minimum to be investment grade. And, Tim, we're really interested in your thoughts on how that's going to impact the Indian bond market. I'm sorry, Tim, you're on mute.
Sorry, apologies for that. I thought it would be automatic. So thanks, Rebecca, and hello to everybody. So from an index perspective, which is how I'll answer it, I'm sure Srini will comment on other things as we go through this. Index providers typically are focused on accessibility above all else. Certainly that's the case with FTSE Russell, and that's what our engagement has been on the back of with India over the last 12 months. So obviously good progress has been made in terms of some of the initiatives that have been mentioned earlier in the conference around accessibility and foreign exchange markets, the introduction of FARs. But having said all that, the credit rating does have an impact on that. It tends to be a threshold that is looked at by each of the index providers, and it's different because the purposes of the indices are different. So if I look at if you look at the JP Morgan, my understanding is as long as it's not in default, then it can be included, the market can be included in their emerging market indices. If I look at the FTSE Russell emerging market, again, that would be the same. As long as the market's not in default, then it's able to be included in those indices. But then you get into the global aggregate, the Bloomberg Barclays global aggregate. The investment grade seems to be an important characteristic within that index. So if a market falls below that, it may be that it can't be included in those indices. And similarly, and for the World Government Bond Index, the threshold is actually a lot higher than the investment grade. It's actually at the A- level. But once a market is in that index, it can stay in that index until it falls below investment grade. So you can see that there are differences, and it depends upon what is the real focus around index inclusion. I think one of the interesting things is that accessibility is such a key component of this, and how India manages to try and maintain the credit rating it currently has, while going through a large amount of the change that it's started on, the change path that it started on. I think is going to be an interesting thing to observe over the next few months, years.
And Srini, do you want to add any color onto that?
Yeah, Rebecca. I think the downgrade by Moody's, was a bit of a catch up, to probably to Fitch and S&P, it's fine, and I think India can live with the downgrade. The point is, if you look at it again a bit historically, right? India has never defaulted. Even during 1991, we actually pledged our gold rather than go through the ignominy of default. Almost all our sovereign borrowing is in local currency, with a captive investment audience for Government of India, right? So So we understand, and take into account the downgrade. But I don't think, it's really going to be a big game changer. And that's exactly what the market also indicated. There's a bit of a sell-off at the time of the announcement. The markets basically came back right up, right? I think, really from an index perspective, government and RBI are well on their way to basically create the outstanding bonds. They had announced a bunch of outstanding bonds from last year, as well as new benchmark bonds, 5-year, 10-year, and 30-year benchmark bonds outstanding, which will be included in the index. As per our calculations right now, this stands at around $77 billion. And, by the end of June, this outstanding should grow to about a little close to about $90 billion. And basically by September, this should, essentially hit about $120 billion. And then, hopefully it kind of paves the way for having a constructive dialogue with the index providers at that point in time in terms of a possible inclusion. Our own calculations right now basically indicate that around this level of outstanding, they should basically get a weightage. India should get a weightage of around 8 to 9% in the NB, and in the Bloomberg aggregate index, we should basically get a weightage of close to about 2%. Should basically see inflows on account of this anywhere between 20 to 25 billion at the outset.
Thank you. And do you think that there's any risk of India going to junk?
I don't know. My own view is that if you really look at the resolve of this government, despite such a huge shock and a clamor really for opening up the fiscal purse strings and go the Keynesian way in terms of making allocations in the budget, the government has refrained from doing so. Even as it announced structural reforms and said that these structural reforms have a value of 20 trillion INR and amount to 10% of the GDP, but the actual budget impact of their proposals have just been about 1%, a little over, marginally over 1% of the GDP. So the government also realizes that they really don't have that much degrees of freedom, really in terms of getting on into a big fiscal expansionary policy. And obviously, they are mindful of the fact that they need to take into account, comparable emerging markets, who are basically part of our bucket, and the extent of outstanding, debt that is there. So India's debt is, is close to about 70%, and given the nominal growth shock, it's very likely that this debt actually goes up to around 80%. So really, there aren't that many levers or degrees of freedom, as is widely discussed, amongst market participants. So I think the government is fairly conservative and is actually stuck to the script.
That's interesting. Tim, do you have any thoughts on that?
No, not really, Rebecca. The index analysis really doesn't focus on that so much. It's really on the practical experience of what it's like to invest as a foreign investor, and I think that's the acid test for us.
Okay, great. Can we see the answers to the polling questions? Okay, so that's interesting. When we ask the audience which are the key items that the Indian regulators should prioritize to attract greater international investment in the Indian bond market, the majority responses were a larger pool of liquid bonds to which to invest and establishing a clearing and settlement link with Euroclear. I'd be interested to hear what your thoughts are in terms of how you see key regulatory developments for the rest of 2020 unfolding. But I can say that ASIFMA has been working very diligently to try and improve the mechanisms with which bonds are sold on Euroclear from the Indian market to the international investors. With that, I'm going to turn it over to Srini to start sort of share your thoughts on whether you share the audience's view on what the most important regulatory developments are for the rest of the year.
I think, really from a regulatory perspective, there have been some landmark, pieces of regulation that's actually been designed and been rolled out by the Reserve Bank of India. I think fundamentally it can change the nature of the market. At the outset, what they've actually done, and this is really the part, of the internationalization of the rupee. And there are two pieces of regulation that basically provide a tailwind to that policy of internationalization. One is the expansion of market hours, right? Essentially, we actually move, from the FX side, from a 9-to-5 market to a 24/5 market. And I think, that's pretty significant. To some extent, it's been challenged by the current COVID situation, but, we should get back, be right back there once things normalize. I think the other piece of regulation that's again a game changer, in my opinion, is really the liberalized FX hedging regime. Essentially, the RBI has moved away from being, prescriptive in terms of the regulatory framework to being more principle-oriented. And that fundamentally shifts the nature of how we conduct our business really on the sell side. And it kind of sets us thinking in terms of the entire value chain from a pre-trade, trade, and a post-trade perspective. And I think that's pretty interesting. These new guidelines actually open up the kind of products that can be made available, for users to hedge. So we, pretty much see, a mini Cambrian expansion, if I could use that word, in terms of the products that will be made available for investors to hedge. The other thing I think that's pretty significant is that they've actually allowed anticipated exposures, in addition to contracted exposures, to be made, which can be used to actually hedge an exposure. I think that's pretty significant. And the other element, I think the other element, really is that dynamic hedging essentially is possible. So participants can right now dynamically hedge their exposure, which in the new regime, which is very, very restrictive in the current regime, which is going to expire, by September. So I think all in all, I think very good moves, in terms of opening this up. I think what the regulators actually also realized, Rebecca, is that, and this really comes as a fallout from the Usha Committee recommendations, which they're implementing in phases, that, essentially, regulations create a wedge between the onshore and offshore market. And what they've actually observed in the process over the last decade or so is that India has actually exported a lot of its markets and hedging activities to offshore jurisdictions, over which the regulator does not seem to have much of a control. And this whole policy measures that they have taken is to ensure that they dial back on some of this market alienation that's happened, to bring back a lot of these hedging markets back onshore, and to ensure that actually volumes occur onshore rather than offshore. And a lot of the price signaling that happens during volatile times actually is kind of pulsates from the onshore market and not really from the offshore market.
That's true. And Tim, what do you see as sort of the key regulatory developments for the rest of the year?
Well, I think, Rebecca, that I applaud the Indian authorities for being able to continue to make progress during COVID-19, really, in terms of some of the initiatives they've had. In talking to participants, though, those new initiatives haven't really been tested to any great extent to this point. And I think obviously seeing the practical improvements that they bring is obviously a very important requirement, and hopefully they will be everything that people want them to be. I think there are still issues around the edges of these which probably need more clarification, and I know ASIFMA are working with the authorities around some of the tax wrinkles that exist around CGT and tax on coupons. I mean, a level playing field for everybody is important within the context of consideration. I think the one that's probably critical, and that's shown itself in a lot of other markets that we look at, is the foreign exchange side of things. So if the developments that are foreseen in terms of both onshore and offshore, more fungibility between the two, more hedging instruments, more liquidity in the hedging instruments, because obviously the cost of actually putting on a hedge within India has detracted quite a lot from the return that can be achieved from the bonds, and that is obviously a major consideration in terms of the way people view markets. We look for efficiencies within that sort of regime when we're looking at the inclusion of markets. So I think all those steps are the right direction, but probably they'll need to be fleshed out and tested and expanded through time. But there seems to be one of the positive things that I would say that we've observed in the recent time is the openness of the regulator in terms of listening to the requirements of international investors, which we hope we represent in terms of our dialogue. And I say that they are continuing to drive this forward in what must be a very difficult environment for them a lot of the time.
Yeah, that does seem to be a consistent theme that we've heard throughout all the panelists today, that the regulators have been incredibly helpful and transparent and cooperative. Srini, I'm sorry, are you trying to speak?
Yeah. Sorry, Rebecca. If I could add to what Tim has said, I think there are other two pieces of regulation which I wanted to highlight to the audience are again like game-changing pieces of regulation, right? One is the entire liberalized NDF framework, where now they've actually allowed onshore banks, to participate and underwrite risk in the vulnerable forward market. Who would have thought, even 5 years back, that something like this would be envisaged and executed, right? And that's gone on stream from the 1st of June. I think which is pretty significant. And again, I think really the fully accessible route, which they've kind of announced, that's just a necessary condition, but the sufficient condition really is when they come out with the guidelines for the international central securities depositories, so that players like Clear or Clearstream can actually set up operations over here. I think both these, in addition, in conjunction with the steps that they've taken, really from a hedging perspective, are triumvirate of policy tools that actually further the objective of internationalization of the Indian rupee. I think very, very potent policy signals coming in from the Reserve Bank of India, and even COVID-19 has not deterred them from actually promulgating these regulations and following up with market participants to ensure execution.
Rebecca, can I make one more observation just from another conference that ASIFMA hosted earlier or last week, in relation to whether there is almost a competition that evolves on the back of COVID-19 between the regulators to make their markets more attractive to international investment. Obviously, there is significant debt being run up during this process, and the focus most naturally is on creation of jobs and getting the economy back working again. So there is going to be a need for international investors and making it as easy as possible for people to come into markets could be an area of competition, because historically it's been very much a slow and steady type of approach, where it's been most important to make sure that there's no disjoint between onshore investors and offshore investors, and I'm sure that will still be the case, but I think we could see around the region a more acceleration in terms of making markets more attractive to international investment.
And Tim, when you say that, are you really thinking of India, China, or?
No, I mean, I think there are other markets like Vietnam would be another
right.
Another example of a market that is on that cusp of looking at attracting international investment into their marketplace. So I don't think, I mean, obviously India, China is key in that, but I do think there are other markets which also may want to participate.
And I mean, maybe as a closing comment, you can do a little bit of a comparison in terms of the development of the Chinese market versus the Indian market for the audience.
Yeah, well, I think the Chinese market is probably a couple of years ahead of where India is today, and I think they have, there's been a lot of engagement with Chinese regulators along similar lines as we're now engaging with the Indian regulators to express the views of the international community, and for obviously the local regulators to make their own mind as the path they want to actually go down in order to open up their markets. It's certainly not for us to dictate how any market should open up. It's important that the regulators, look after the interests of all the community that they want to look after. We can obviously help them by giving them some of the things that international investors would like to see, but that path is very important. And I think to date, China has done a reasonable job at providing a pathway, slowly opening up their market, testing it. And I think what I see from India, it is starting down that path. It could well accelerate, but it'll be interesting to observe in the short term.
Thank you. Srini, we're really running short on time now, so I'm just going to give you 2 minutes to close and share with us any thoughts you have that you'd like the audience to take away.
Yeah, I mean, thanks, Rebecca. I think, India, the resiliency of the market microstructure, has been tested pretty much very acutely from a COVID-19, post-COVID-19 perspective. But I think the market microstructure itself is inherently resilient, and we are open for business. Of course, the market hours are truncated, but nevertheless, liquidity is slowly climbing up back to normal levels. And I think, above all, I think India is an exciting place to do business, given some of the game-changing pieces of regulation which are underway, and really should be, front and center, really, of investment plans, for a lot of investment committees from a long-term perspective.
Thank you. Thank you, Tim. Thank you, Srini, for sharing your thoughts with us on the Indian bond market. I'd also actually like to thank the audience for participating and bearing with us through technical difficulties and staying on a little bit longer. I'm now going to turn it over to Millie to close the session.
Thank you again for joining us today. Our next virtual event will be on Wednesday, June 17th, EU policy response to COVID-19 to support the markets and economy. This is again a free event, so please reserve your seat by either scanning this QR code on the screen or visiting our website, www.asifma.org/events. We hope to see you there. Have a great evening. Thank you.